You probably think your $180,000 in tax-free QSBS gains are locked in stone. You held the stock for 5 years, your startup is profitable, and you're getting ready to cash out. The IRC 1202 exclusion has your back, right? Wrong, if you make one critical mistake in the next 12 months. Most CPAs never connect these two decisions, when you surrender your life insurance policy and when you recognize your QSBS gains. But they're directly linked through something called Modified Adjusted Gross Income, or MAGI. And here's the trap. One wrong move costs you $45,000 to $63,000 in federal taxes, completely avoidable. Let me walk you through exactly how this works. IRC 1202 is one of the most powerful tax weapons available to startup founders. If you meet the requirements, held the stock for 5 years, bought it at original issue, it's a qualified small business, you can exclude up to 100% of your gains when you sell. That's not a deduction, that's complete tax erasure. For someone with a $300,000 exit, that could mean $180,000 in gains that the IRS never touches. That's the dream scenario. But here's what most founders don't realize. Your MAGI in the year you sell determines whether you even qualify for that exclusion. And it's not just about the capital gain itself. Your MAGI includes everything: W-2 income, dividend income, interest, rental income, and yes, the taxable gain from your life insurance policy surrender. Let's say you surrender a life insurance policy in December 2024. The policy had a $95,000 gain built in, meaning you paid $150,000 in premiums, but the surrender value is $245,000. That $95,000 gain becomes reportable income immediately. It hits your MAGI in the exact same tax year. Now let's say you're planning to sell your QSBS in early 2025 and recognize a $280,000 gain. Here's the problem. Your MAGI for 2025 includes that $280,000 gain plus the $95,000 from the insurance surrender. You're now at $375,000 in additional income that year. Some of that gain might fall outside the QSBS exclusion window because of your elevated MAGI. That's how you lose the tax-free treatment. But there's more. This compounds at state level too. High-tax states like California, New York, and Massachusetts layer their own capital gains taxes on top. If you're subject to a 13.3% state tax rate, that $180,000 in protected gains just became a $23,940 liability. Combined with federal taxes you didn't expect, you're looking at $63,000 in total tax leakage. Here's the third layer most people miss. Once your MAGI crosses certain thresholds, you trigger net investment income tax on top of everything else. At $250,000 in MAGI for married filing jointly, the 3.8% NIT kicks in. That's another $6,840 in taxes on a $180,000 gain. Your CPA might not even mention this because they're not looking at the holistic picture. So what's the solution? Sequencing, pure sequencing. If you surrender the life insurance policy in January 2026 instead of December 2024, you split your MAGI across 2 tax years. Your QSBS sale in 2025 stays clean. Your insurance surrender happens in a different tax year where you can manage it strategically. You might take that $95,000 insurance gain alongside charitable contributions, capital loss harvesting, or other deductions that offset it. Or, and this is the aggressive move, you sell the QSBS first in January 2025, recognize your $280,000 gain protected under IRC 1202, then surrender the insurance policy in the same year, but paired with major charitable donations or other offsetting strategies that reduce the net MAGI impact. The math changes everything. Selling QSBS clean in 1 year, then timing the insurance surrender for the following year, could mean the difference between owing $63,000 in taxes or $18,000. That's $45,000 in real money that stays in your pocket. Most CPAs see these situations individually. Your tax person handles the exit. Your insurance advisor handles the policy. Nobody's in the room looking at both. That's the gap. That's where the $180,000 disappears. You need someone who asks, when are you selling? When is your insurance maturing? What's your MAGI timeline? Not in April when returns are due, in September or October when decisions still matter.